Hello my people, welcome back to this YouTube channel. So today I'm going to teach you about the 7 institutional reference points. This is the footprints of the institutions where they take their orders, either the buying order or a selling order. So this is the footprints of the institutions, how they take their orders in the market. Either it can be a buying order or a selling order. So today I'm going to take this time to maneuver, or I'm going to teach you one-on-one how to mark the 7 institution reference point, how to draw them, and you can search them in your chart. So thank you. Let's proceed now. So today I'm going to let's start with the first one, which is the mitigation block. Mitigation block. As you know, mitigation block, we have a bullish mitigation block and we have a bearish mitigation block. A bullish mitigation block is a mitigation that this is a bullish mitigation block is a mitigation block. It's a footprint where they are taking buying orders, while the bearish one, where there's a selling orders, the institution take their selling orders in the market. So let's start with the bullish mitigation block or a bearish mitigation block. Bearish mitigation block, and the other side we have a bullish mitigation block. Bearish mitigation block and a bullish mitigation block. So let's start with a bearish. The market was recently on uptrend. The market was breaking, breakout structure, and we came across a market structure shift. Breakout structure, and we came across a market structure shift. So I want you to observe this. This is what we call a mitigation block. This is what we call a bearish mitigation block. The market was recently on uptrend, but there's a reversal in the market. There's a market structure shift here. When a market structure shift occurs, it means that the market has changed direction from a bullish market to a bearish market. So there's no you can see there's no sweep of liquidity above this high, this recent high. There's no sweep of liquidity here, and that confirms that this is a bearish mitigation block. And a bullish mitigation block. The market was recently forming lower highs, The market was recently forming lower highs and lower lows. There's a break of structure on the downside. And the market changed direction. Market structure shift. The market changed direction. Let's take this. Our mitigation block is this one. It's a bullish mitigation block. After reversals, you wait for market structure shift to undergo after market structure shift. So you can position your positions. You can now enter into the market. Yeah, but after seeing other confirmation, you cannot just wait the market has changed the direction and you just enter abruptly. No, you must wait for other confirmations, the entry models that you have. Yeah, this is a mitigation block. We can delete now and start on we can continue with we have complete our that's how you identify a mitigation block, and we can proceed with a breaker block. So we have a bullish breaker block and a bearish breaker block. We have a bearish breaker block and the opposite one is a bullish breaker block. A bearish breaker block, the market was recently on uptrend and there is a sweep of liquidity. There must be a sweep of liquidity. After that, the market come, then change direction or continue with the direction. Yeah, there must be a sweep of liquidity. You can observe that this mitigation block and breaker block, they seems like they're the same, but they're not the same. There's a sweep of liquidity on the recent high. There's a sweep of liquidity on the recent high. And there's a market structure shift. The market changed direction and reversal in the market. Market structure shift. So after market structure shift, this is also a valid it was a valid order block, but the market mitigated it. It mitigated and traded below. After trading below it, it forms um, a bearish mitigation block, breaker block, and the opposite is the same. The market was recently on a downtrend, forming lower highs, lower low, and there's a sweep of liquidity here. The market came here, then changed direction. Yeah, you can see there's a market structure shift. There's a market structure shift. You can see there's a market structure shift. The market was on a downtrend, forming lower highs and lower lows. That's a bullish mitigation block. You wait for a retracement into this mitigation block, then you buy into this recent buy side liquidity pools. Buy side liquidity pools that reside above this one. Your first take profit can be here. I always put my break even after taking the first buy side liquidity pool. These are buy side liquidity pools. Buy side liquidity pools. Something I need to into the recent buy side liquidity pool. So another the next one is the fair value gap. Fair value gaps. We have a bullish fair value gap and a bearish fair value gap. A fair value gap is also known. It's also known as in short term you can call it AVG or imbalances. Imbalances in the market. So we have a fair value gap. Let's say the market was trading down. You can identify fair value gap using the 3 candlesticks only, not 4. 3 candlesticks. This market is on a, so you mark the recent this week. That's an AVG. That's a AVG. You can call it a 1 hour AVG or either 15-minute AVG. So the market was recently on a downtrend. It was forming this one. The market will retrace on that AVG and continue. You wait for a retracement due to this AVG, a fair value gap, then you sell your market. Yeah, this is a bullish, it's a bearish AVG. It's a bearish AVG. My laptop is almost running out of the power. I need to charge. We can now continue. It's a bearish fair value gap. A bearish fair value gap. So you can let's draw a bullish fair value gap. Market forming high and this. It doesn't matter on the color of the candle. Never consider the color of the candle, just draw it. You can call it a 1 hour AVG. The market was recently on uptrend. This is an uptrend market. It was forming. You wait for a retracement into a fair value gap, or that's an imbalance. Yeah, you wait for a retracement into that fair value gap. After a retracement, you can place your buying opportunities, your buys here into the 50% of the that FEG. Yeah, that's a fair value gap. The next one is an order block. An order block is the last. An order block is the last. An order block is the last sell candle. And we have a bullish order block and a bearish order block. A bullish order block is the last buy candle on that buying, the last candle that was selling, which is a bullish order block. And a bearish order block, you consider the last buy candle. Let's take an example. An order block we have a bullish order block and a bearish order block. Take this example. The market was recently on a the market let's change the color of this candle to be either red. Sorry. You can leave it like that. So one thing that you're supposed to write down: a valid order block, it must have a fair value gap. It must cause a market structure shift or a break of structure. It must have a fair value gap. It must have a fair value gap. It must cause either a break of structure or a market structure shift. And another one, it will not be, it cannot be, it must be not be, let's say, mitigated. Yeah, unmitigated. Yeah, unmitigated. Yeah, that's the right word you can use. So this is the last. An order block, take this is a bearish order block. A bearish order block is the last. We consider the last sell candle on this downtrend. The market was recently sorry. Let's first any order block. Let's take that 1 hour order block. Our order block must have an AVG. It must have a fair value gap, and it cannot be unmitigated. It's unmitigated. So this market was on a sell, something like that. Yeah. Yeah. And the opposite of this one is it's a bearish order block and bullish order block. The market is on my next video. I will show you how to identify it in the real chart. But this is just a demonstration. The last candle. It's on. Yeah. So the market only it must come. Then sorry. I need to draw it well so that you can see. The market will come into this order block and buy. This is a bullish order block and this is a bearish order block. That's how you identify order blocks in the market. And my next video I'll show you how to identify it in the real chart. This is just a graphical representation of this, the 7 institution reference points. The next one we are going to discuss a liquidity void. A liquidity void. Yeah, liquidity void. Liquidity void. So a liquidity void, it's a form of imbalances in the market where the market moves without retracing back. Let's take this example. The market is just forming big candlesticks without any retracement. Forming either red candles or a blue candle. It depends on the type of the color that you use on your chart. So a liquidity void, the market move aggressively without any pullback. So this market move aggressively into the downside. After some days or hours, the market will pull back, will come and fill up these voids, will come and fill this void. After filling it, it will move on the same direction. The market came aggressively, but it will fill, then move on the opposite direction, on the same direction. That is, this is a liquidity void. These candlesticks, you can see these candlesticks, these massive engulfing candlesticks. Yeah, that's a liquidity void. How to identify liquidity void in this market? Yeah. And the next one, we are going to discuss hold size, and let's first finish with the rejection block. A rejection block the market was on a downtrend. the market was on a downtrend, and at the same time it changed direction from downtrend to uptrend. A rejection block must have the a rejection block is the last sell candle on a downtrend before a reversal or after reversal. Yeah, and it must have the longest wick. It must have the longest wick. This candlestick, it must have the longest wick. So this is a, you can mark it. This is a rejection block. This is just a rejection block. Rejection block. It's a bullish rejection block. Yeah, the market will retrace there. After some days, the market or some hours, the market will retrace into this rejection block and continue. A rejection block sometimes is, some people refer it as an order block, but this is a rejection block. Rejection block must have the longest wick. It must have the longest wick, and it's the last sell candle on. It's a last sell candle when the market was on a downtrend. Yeah, the opposite of this one is the same. The opposite of this one is the same. This is a rejection, or this is a bullish rejection block. Yeah, I think you can take this an opposite of this one. Yeah, this is my assignment. Do this one, opposite of this one. The opposite of this one is that's a bearish rejection block. Or I can do for you. Let me just do for you, my people. You know that I like you so much. I like my people, my audiences, my audience, my forex traders, my forex students. You can see I'm doing everything just for free, just teaching you everything for free. This a rejection block. The market was on, then it will come on this one, then this is a bullish rejection block. When the market retraces back into this rejection block, you can sell now after seeing other confirmations. You know that forex is a game of probability. You can't just guess the market. The market will teach you wonders. The market will teach you wonders. The market will teach you wonders. So let's continue with all eyes and all lows. All eyes and all lows. All high, all lows. Is an old eye. Is an old eye. It's an old eye. This is an old high, another old high, and this is an old low. The market will take it later. And sometimes I call this one sell side liquidities. Because the market will come and take it later. Sell side liquidities. Sell side liquidities. Yeah, that's all that I can teach you about the 7 institution reference point. Please make sure that you like, share, and subscribe. I'm going to show you my next video. I'm going to teach you all the 7 institutions reference point on the chart. I'm going to teach you on the chart. So goodbye.